So we'll go ahead and get started. Hello, welcome to the GFI Business of Alt Protein Monthly Seminar. My name is Audrey Gear, and I am a Startup Innovation Specialist at the Good Food Institute. For those of you who aren't familiar, the Good Food Institute is an international nonprofit organization that is developing the roadmap for a sustainable, secure, and just protein supply. We identify the most effective solutions, mobilize resources and talent, and empower partners across the food system to make alternative proteins affordable and delicious. Please visit gfi.org to learn more about our work. Before we begin today, just a few housekeeping items. First, this seminar will be recorded and we will post it to our YouTube channel following today's session. We will also be emailing you a copy of the recording. You can also view previous seminars on our YouTube channel. Second, this seminar will include an audience Q&A for the last part of the hour. Please ask your questions in the Q&A box rather than the chat. That helps us keep better track of them. You are welcome to ask your questions throughout the seminar, but we will likely only get to them towards the end in that Q&A portion. And third, immediately following this panel today, we will be hosting a virtual networking session via the Meetaway platform. So we'll drop the link in the chat that will take you to the registration page where you can sign up if you haven't already. And this is just a great opportunity to meet other professionals in the alt protein industry. You'll be matched with several other people for one-on-one conversations. I know I've met some fantastic people at these mixers, and I really encourage you all to join us. Just remember, you do need to sign up via Meetaway to access that networking. And this will start right at the top of the hour once the panel ends. So with that, let's dive into today's panel about the alt protein investment landscape. Our experts joining us today are Matt Spence, who is a managing director at Guggenheim Partners, where he is an investment banker focused on sustainability, alternative proteins, and emerging technologies. Marylise Holm, who is the co-founder and partner of Sustainable Food Ventures, an early stage venture firm in the alt protein sector. And Christina Ulerdick, who is a partner at Standard Ventures, an impact investor that backs companies across the agri-food value chain. Matt, Marylise, and Christina, welcome. We are so lucky to have you here today. And before we dive in, to frame the conversation a bit better, can you each elaborate a bit on what brings you to your current role and how you spend time in the alternative protein space? Matt, could you kick us off with that?
Sure. And I'm really fired up to be with everybody. So I'm a managing director at Guggenheim Partners, and I'm an investment banker. And we're an investment bank who takes companies public. We worked on Oatly's IPO. We have worked on mergers and acquisitions. We represented Disney when they acquired Fox in their last 3 companies. And we do some of those large transactions. We also raise capital for companies. And I came at this from an unusual background as a banker, is I started my career at the White House and at the Defense Department. And when I was at the White House, President Obama asked us to start looking at the impact of several industries on climate change. And of course, as we all know, industrialized agriculture has an enormous impact. And working on that really struck me thinking about it. And then when I was at the Defense Department, I was the Deputy Assistant Secretary for Middle East Policy. And I was struck that when I was traveling to the Middle East and talking with heads of state and leaders of countries that were worried about the war in Syria or the war with Iran, they were as concerned about water scarcity and food scarcity. And I was really struck that there needed to be some areas in the form of trying to have better innovation for technology to address these problems. And then I was in Andreas Horowitz before joining Guggenheim Partners. We looked at and did a diligence on a number of alternative protein companies. They were early at that stage, but it really got me fired up to think about 2 things. One is there's an enormous national security and global impact of alternative protein that the very business model of companies that all of those on the webinar here are starting has the potential to be tremendously transformative. And second, just as a stage of capital raising, it's a fact companies are moving from being great venture-backed companies to scale up with capital to truly have a global impact. And it's a really interesting time to be working with those to think about how do companies navigate investment decisions, finding sustainable sources of capital, and really getting the rocket fuel that they need to do amazing things to execute on their global missions.
Thanks so much, Matt. And Marylise, what brings you to your current role, and how do you spend your time in alternative proteins?
Sure. Thank you. Thank you, everyone, for being here. Very excited to share my experience so far. So by training, I'm a food scientist, and I've been in the industry for about a decade. And my first connection with alternative protein was about 7 years ago when I was doing my master thesis. And at that time, I wasn't vegan or plant-based. That world was very far from me. But after some independent research and working on this topic extensively, I ended up switching and focused all of my career in the alternative protein space. And now for the last 1.5 years, I've been on the investment side of the industry. And mostly during my days, I talk with early entrepreneurs, and through Sustainable Food Ventures, which is an early stage VC company, we invest in companies that are plant-based, cell-based, or recombinant. So usually my days are filled with very exciting conversations about what the future is going to be and how can we change it already today.
Thank you. And Christina, how about you? How are you spending your time, and what brings you to this world?
So good morning or good evening for the ones in Europe like myself. I'm a partner at Astano Ventures, and Astano Ventures does invest from what we call the farm to fork. So it's one of the teams that had started early investing in Europe and the US in 2017. The firm was founded. We have a venture fund that is 260 million euros large that we closed. And again, the sectors along we invest are quite broad. My background is a climate scientist, so I started from the climate angle that Matt has talked about, and then did business development and incubation for a decade in emerging markets, where if you followed the developments in the past decade, it was all about fintech, leapfrogging, frugality, using very little resources. So being part of the M-Pesa wave that led to fintech, mobile banking, we have worked a lot in the agri-food value chain. And with that on the ground kind of know-how, how it is to work with growers and everyone in the value chain and the type of technology that is needed, I joined Astano Ventures. And for us, the alternative protein space is one space, of course, where what is really important from a planetary perspective is CO2 consumption, animal welfare, of course, and resource efficiency. But looking at proteins, we are also increasingly taking the angle of efficacy, bioavailability, the nutritional value of the food that we eat that matters largely. So we have been opening the radar much, and the mantra here is really that it's not about calories, but it is about nutrients and feeding the world healthy.
Thanks so much for all those introductions. We clearly have such an incredible range of backgrounds on this call, from national security to emerging markets to food science. So I am really excited to dig in. And when we were first planning this panel, it was a month or so ago, and clearly a lot has changed in the market over the past few weeks. We're seeing major declines in the stock market, rising volatility. And how would you describe the investment climate right now? How has it changed, and where do you think things are heading? What does this mean for the alt protein sector? I'd love to invite all of you to weigh in on that.
Yeah, I can go ahead. So since Sustainable Food Ventures is about 50% of the time the first investor into the company, I would say we're very early stage. And thus far, I haven't seen much of a change in the last month or so. I would even say that the deal flow of companies has increased, specifically in the seed stage. So I think the early stage, such as pre-seed and seed, will be affected the least in this economy, but I'm sure the other panelists can talk more about the later stage companies.
So since we are investing from seed to later stage, I'd echo the sentiment that if you read reports, if you talk with VCs, if you talk with founders, seed stage investment might almost be like anti-cyclical, because you always have founders coming up with good ideas, and the food system needs disruption very urgently. And the quality and the caliber of the founders has really risen, in a sense that a lot of people who a few years ago would have gone into software SaaS development are now going after impactful material businesses. So you see a lot of very, very high caliber founders, also like repeat founders. So I'd say too that seed stage is probably the most sheltered from the current environment. And then the A/B series, we will talk about how to increase a runway, perhaps later in the seminar, how to make sure that you raise funds at a very good time. I think late stage, just looking at the pitch book data that came out just recently, some of the valuations are down up to like 40% haircut. And that's something that starts to kick off with the announcements of SoftBank, curbing back their involvement when you look at the Temaseks of this world. But I'm sure Mark has more to say here. Matt, sorry.
I think I agree with what Christina said. I think we're at a really interesting time overall in the market. There's been a tremendous amount, obviously, of great early stage seed and venture investing in terrific entrepreneurs. What we're seeing is, because so much of alternative is inherently capital intensive, I mean, unlike software eating the world, or unlike cryptocurrency or blockchain, real capital is required to manufacture, innovate, and distribute these types of technologies in this food. So one interesting trend is you're seeing a lot of sustainability investors, which are large traditional investors who probably have not spent time in alternative protein, have not spent time in food technology, were increasingly interested in the sector. And part of the reason that they are is there are large buckets of capital which LPs would like to put into sustainability, be they from pension funds or university endowments or others. And that capital has often been deployed in batteries, automobiles, utilities, and power. And a lot of these investors are looking for diversification out of that sector. So food and agricultural technology, of which alternative protein is one of the most interesting sectors, inherently becomes very that. So that's an enormous opportunity. Of course, with the opportunity, obviously comes some considerations and some drawbacks. Part of the drawbacks are, when a lot of those larger investors are coming in, the expectations traditional financial net look at the return profile for the thing is there's available to go into the alternative protein sector from a range of sources. However, the bar for companies to raise at that level is higher, and there aren't as many companies who are in this space.
Great, thank you for those perspectives. I know that we have been talking to quite a few startups who are about to start fundraising and are a bit concerned about doing so in this environment. And recently, Y Combinator, the Silicon Valley Accelerator Program, that has launched some very successful companies like Airbnb and Coinbase, they wrote a letter to their portfolio companies that's been making its way around the internet, basically saying that they should plan for the worst with this economic downturn. And I'll just read you a small quote from this letter. It said, "If your plan is to raise money in the next 6 to 12 months, You might be raising at the peak of the downturn. Remember that your chances of success are extremely low, even if your company is doing well. We recommend you change your plan. And what is your take on that advice? What do you recommend to founders that are fundraising now or who are about to start fundraising?
So I'll chop a few keywords and then let the others chip in. So we second that notion, and we have discussions currently with almost all of our portfolio companies in terms of the runway. So rather have the 24 months than the anticipated 12 or 18th. And there is lots of options, of course, to decrease costs. Look at how could one bootstrap a bit more, consulting with the investors, leaning on their expertise, discussing what steps could be taken. A lot of people also speak about venture debt these days. This is something that comes up. There have been lots of new funds in the market. Is that an option? Is that a cheaper option compared to equity? Could it be used for funding?
Marlies, what is your perspective to founders that are about to start fundraising?
Yes, so we have in the last 18 months, we've invested in 45 companies around the whole globe. And just the first two have now entered into Series A, which is the big thing to kind of hop over, because a lot of companies don't make it beyond the seed stage. So Series A is really the cutting point. What we have said and thought internally is that actually do raise in the next 6 months rather than in the next 6 months after that. So we feel that in the food sector, it hasn't necessarily been that dramatic as maybe in other few sectors, but our advice has been do raise in the next 6 months, but if you if you have to do the raise in the next year, do it in the next 6 months versus a bit later, because we feel that the pre-seed and seed stage are still sheltered, as we said earlier, but we don't know how things are going to be 6 months from now.
And I think I would say on the growth side, it's interesting that obviously the public markets have been very choppy and very difficult. And this is something that's far bigger than anything in alternative proteins. Netflix, Google, larger things have gone down. And there has been an overall resetting of values and expectations in the private markets. So I see in the large rounds, you are seeing some flat rounds and down rounds. You're seeing the terms tightening of particular deals. You're seeing deal flow and deal activity tightening. So those are all some of the headwinds. On the other side, there is still a tremendous amount of capital to deploy. And I would say if you're a company who knows that you need to raise at some point, one of the best things you could do is prepare your financial model, prepare your debt, prepare your data room, and think about some of the metrics that you want to be hitting so that you're ready to go out into the market when the market is most advantageous, but you're prepared and ready to take advantage of that opportunity, whatever's ready.
Thanks for that, Matt. And I know you were breaking up just a bit with the last question around the investment landscape and how things are changing. Could you just go back and revisit your perspective on what's happening with the later stage companies for those who couldn't quite hear you?
Sure. So I think with some of the later stage companies that there are a new round of investors who have capital that they're very interested in deploying in sustainability. And they're looking to diversify away from the large amounts of capital they've invested in batteries, cars, power and energy, and sustainability around food and a lot of the climate change mitigation issues, very important and very helpful there. So that creates a lot of momentum around investors who have not been either maybe mission driven or specialty investors in the space that create some opportunities for them.
Thank you. And I just want to shift directions a little bit, and I have some questions for each of our panelists. And Marilise, my first question's for you. And you invest in very early stage companies. You're often the very first one to write a check. Investors are obviously looking to find great entrepreneurs and great businesses. But what else really matters at those earliest stages? And how are you making those decisions?
Sure, happy to share. I think that the three things that really matter to us are, of course, the people that are founding the company and then what they are planning to do, so the business aspect. But also one of the things we look at is the location. As we are a fund that is investing globally, we're now present in 18 companies and in the five continents. And we firmly believe that it is possible that in the future we have a lot of regional winners or leaders. So we do believe that there are going to be national champions because food is so cultural and location inherent to the location and culture that people are living in, that we believe that specifically in alternative protein space, it's very probable that a lot of winners will emerge from different places. So one of the things, in addition to the team and the business itself, we look at is the location. And one other thing that I would like to mention about the team is we like funding and supporting founders that are missionaries over mercenaries, meaning that they do it for a very personal why. They have a very specific reason why they're doing this. And we've just seen over time that the people who have a clear passion and a reason why they're executing every day, they just end up finding solution in places where many people would just give up or decide to not take the hard path. But oftentimes these founders who are really there for the mission, they do end up doing incredible things.
Absolutely. Well, it feels like there are many mission-driven founders in the alternative protein sector. And Christina, I'm interested in your perspective on those regional differences. You're based in Europe, but you are a part of a global firm. And what would you say are those differences, for example, between the European and US investment landscape? How much does geography matter to you when you're making investments?
Well, I mean, one thing that we said earlier is the stages that may matter in this crisis, early versus later stage. I think later stage, Europe is still, in terms of funding, pretty much dependent on the big US investors. In 21, roughly 40% of the capital rounds of around 250 million in the European space came from the big US funds. So that is something where Europe is then pretty much tied. I mean, I've given some of the big names earlier, the soft banks of this world and what they do. Europe is also closer in terms of supply chains and agricultural market to the war in Ukraine, of course. So depending on the business model, depending on the labor, depending on the exposure, that of course has a very immediate effect on some of the businesses, perhaps not the ones in Portugal, but certainly the ones in Eastern Europe. But other than that, I think the world and the VC world is a very global world. And yes, I agree with the regional leaders, but the funding tends to be increasingly international, especially at the later stage rounds. So everyone is sitting in the same boat. This being said, however, and the point was made earlier, if you have an outstanding business, if you're an outstanding founder, if you're not the 20th e-commerce solution, if you do something really, really novel, deep tech, you will always get funded.
Mm-hmm. Yeah, absolutely. And just to maybe build on some of that a little bit, Christina, what kind of growth metrics, what metrics of success are are important to you? Many alt protein companies are developing very novel technologies, and it can be a pretty long time horizon before they bring their products to the market. And how do you evaluate their progress in absence of revenue or in absence of having their product actually out there on the market?
I think something that is available to like a Series A or B investor is always what has happened between a pre-seed, seed stage and the Series A, B round. So what the company came or the team came up with in terms of milestone or their what is called technoeconomic analysis. How did it pan out? How did it work from lab to pilot and perhaps the first demo that you might be at AB? So that could be an indicator for, what were the assumptions, etc. We, of course, think about the scalability of a business by the process applied and look at where could costs eventually go to. That is not an exact numbers game, but again, I think you can paint a trajectory, both in terms of production volumes, both in terms of the business model, the COGS, the cross margins, so that you have an idea also about the nature of the business. Is that something where for a long time nothing happens because of the regulatory process, and then you have something that is very scalable? So you have a biotech hockey stick type of curve, or where you have like gradually, you do a little bit at a higher price, a bit more at the lower price. So there is lots of modeling and assumptions that can be made pre-revenue and can be used. And then, of course, there is experiences. You have seen 10, 20, perhaps in some cases 50 companies with similar ideas, similar models, and there is a bit of benchmarking possible.
Absolutely. And kind of maybe backing up a little bit then, Marylise, could you talk a little bit more about the scientific due diligence process that you do at those very early stages? What's critical for you to know, and what do you expect startups to be able to provide at that earliest stage?
Yeah, happy to. We've actually invested in companies where there has been just one founder and an idea in their head, like literally no team, no prototype, no nothing. And we've made the call to invest in that founder. And then just a month ago, so a year later, they have been executing. I met the team, I tasted their product out, like they were sampling, not just to the investors, but actually they were sampling big time in the US market to the general public. So that was a wonderful experience to know that you can actually feel confident about investing in someone who only has an idea and no team, no prototype yet. So that can definitely be done. It's more of an exception than a rule. But some of the hard rules or like internal guidelines that we have in sustainable food ventures is that when a company is going for a deep tech solution, so for example, let's say cell-based meat industry or dairy or whatever they want to do cell-based, we do require that whoever is leading the science side in the team, that they would have a PhD. So that's one of the things that we want the team to have. And also we require that the PhD scientists, if they happen to be a professor at the time, whenever the funding is there to go full time, that the professor goes full time, because oftentimes it's hard for an individual to divide their time between a startup and a university commitment. So whenever there's a teammate who is a professor, make sure they're willing to come in and dedicate their whole time. Otherwise, they could just be an advisor to the company. And then one thing that we also look at in addition is that the IP that the company is planning to, if they already have something or they're planning to create, that they end up fully owning that IP. It's so much more easier to execute when you own the IP versus if you have to license it from a university, because the tech transfer and the universities in general can be pretty difficult to work with. So these are the main things that we look for when companies are doing like I would say, recombinant or cell-based. Plant-based can be, I don't think you necessarily need a PhD scientist in your team. I don't think at all that that's true. You can just get away with a product developer and a food scientist who can do great work in the lab. Yeah.
Thanks so much for that. And Matt, jumping over to you now. Earlier today, you were talking about more ESG investors, later stage investors getting involved in alternative proteins. And how do you think startups should think about reaching that next pool of investors, looking beyond just the food, just the alt protein, just the ag tech investors? What's important to get right when you're going into those conversations?
It's a great question. And I think, there's some things that just depend on your company's level of maturity. So many of those investors will require revenue, and not just revenue, a certain scale of revenue, in the double digits of millions. So you're looking at a different investor profile. So I would think in terms of looking at, what is your 3 to 5 year financing plan ahead? And think of it in terms of a strategy and walk backwards. So right now you may be moving into sort of larger venture rounds, and you can see venture rounds which may be $100 to $350 million. And you'll get a range of some of those when you put together. Then when you start hitting certain markers, you can start reaching into either some of those later stage ESG investors or some of the sovereign investors, who of course, QIA, the Saudis, the Emiratis, the Omanis have gotten a lot of interest in this space, both for economic returns, but also strategic reasons. And then to think about moving into there. One thing that I would say that's an interesting development that you've seen in a lot of these areas are a number of the strategic investors coming in, which I think is one of the questions in the chat as well. And that can come at a range of stages. If you can imagine what would happen if GM or Ford had not just invested in Tesla 10 years ago, but try to negotiate a commercial and strategic partnership, those are some of the opportunities that are happening in the space. ADM, Tyson, Cargill, JBS, a number of those. And companies need to proceed carefully and think about what's the right timing and what are the right terms of such a partnership. But I think those are some interesting opportunities as well, not only for the later stage companies, but some of the earlier stage companies to think about not just getting capital on your balance sheet, but also getting things that can help accelerate your revenue growth.
Absolutely. And Christina, Marilis, I'm interested to hear your perspective on having strategics on a startup's cap table, what you think the pros and cons of that might be and how companies can think about that relationship.
You can go first, Christina.
Well, 2 points. The timing that was mentioned by Matt is really important. At what time do they come in? And then, of course, the ownership and the cap table, perceived conflict of interest. A lot of strategic now have a corporate venture arm. That corporate venture arm then sometimes is said to be independent, is said to be a financial investor with some ties into the business. So that's also to be explored. So not every strategic is equal to every strategic. And then again, that relationship needs exploring. Information rights, confidential information, how do you treat that, especially around competitors, go-to-market, commercial insights? So those are very important questions.
Yeah, I was gonna just mention the information rights in a bit more detail, that it can be a very sensitive topic to the company and also to the strategic that invests. So to just be extra careful there, but also not to the point where you alienate your partners. So I think it's a very fine line to dance between the strategic and the startup. And I think echoing again, the timing really matters when those partners step in.
And I think related to that is companies should be aware that a number of strategics related to information rights will invest in many of your competitors too. So the strategics taken in cultivated meat, for example, may not be ready to make a bet on what individual company is going to going to win. So they'll make some investments across that. And that doesn't mean that you should walk away, and it can still provide tremendous benefits and partnerships and accelerating your growth. But it's just to be aware of what's the right time, what terms, and know in general. And it's not a rule, but strategics are part of large corporate enterprises and tend to move slower than others. So I think one rule that I think about is it's always great to be in a position to raise capital when you're not actually raising capital. So building some of these relationships, getting on the radar, not just of the strategics, but some of the larger sustainability and ESG investors that I talked about is never a bad idea.
Great, thank you. So we have quite a few questions in the chat and the Q&A box. So everyone keep those questions coming. And I'd love to just start to dive into some of those audience questions for all of us. So the first one here is, I believe, around manufacturing and the infrastructure for alternative proteins and developing those ingredients. This person's commenting on how there seems to be a lot of investment for CPG companies, innovation, but not necessarily VC equity investments in ingredient manufacturing. And what is your perspective on that? What are ways that startups can get funding for those capital intensive longer term projects?
So perhaps I'll just start on this one, because we closed an investment on a precision fermentation manufacturer. So not your typical CDMO, but a group, the company is called Planetary, who has a lot of upstream and downstream know-how, is to not just again being a CDMO, but also improving the process for the originators that will be working with the company. And those can be VC fundable models. So if you have a tech tweak to providing capacity in the market, that it can be A, VC funded, and B, I talked about the debt component earlier. It is possible to take some of the CapEx requirements, for example, of your own balance sheet. It is possible not just in combination with equity, but it's nowadays also possible with some of the banks. They all vary in terms of risk profiles and what they would fund, but it is worthwhile to look in terms of CapEx. And precision fermentation capacity has been quite a large subject as to, there is a hole in the universe, because if all the companies that are currently on the market map, if they all were to scale, they need to go somewhere, and not all of them may want to build or may have the ability to build their own big plants.
Yeah, you are absolutely right about precision fermentation capacity being a major bottleneck. So I personally am excited to hear about that investment that you made. Marilise or Matt, do you have anything to add to that? Otherwise, I can hop to the next question.
One way that I might think about this is think about alternative proteins as an overall ecosystem. So a lot of the focus on the large capital raises with the large valuations and the significant revenue multiples have been the innovators who are actually making the proteins themselves, of course. The Eat Just, the Upsides, the Future Meats, and some of those really awesome companies and others. I think two other areas which have just received less attention, but I think are really part of an interesting infrastructure and sort of the picks and shovels to the gold rush strategy are, one, the ingredients, because in the global supply chain, you need to put those in. Those are typically more capital intensive and have lower revenue multiples, so haven't received as much attention. But I think there's an area for maybe a different class of investors to go after. And the third area would be maybe the type of traditional branded products, which aren't manufacturing the new types of protein themselves and innovating that front, but they're delivery mechanisms for new type of food for some of that. So maybe another evolution in the industry is to take a step back and think about, well, you have the very high growth, high IP, strong tech companies, there's room for other players in this space as well, for maybe a different set of a group of investors who might be interested.
Got it. And just to maybe build on that, I have another question here. Talking about venture debt and how it often requires an equity round to occur to allow for banks to attach the debt to the rounds. And what would you say is the alternative to venture debt if the company is between equity rounds?
So just perhaps reiterating on the point that some of the CapEx could be debt financed, and that could happen in between equity rounds.
There's an interesting. I think the industry is moving into a area where there are different financial tools available. So as you said, there's been a lot of focus on raising equity for the top co, the overall company. And you reach a point where either the size of equity raised might be too dilutive, and that becomes challenging too, particularly as valuations are down or flat. So another area for a lot of the companies to think about also is looking at project financing or looking at some of the debt side about ways to actually finance some of the manufacturing facilities, Audrey, that you mentioned. And so I think rather than companies approaching saying, I want to raise venture capital or even growth equity, to think about the number of different tools in your toolkit. There's convertible debt, there's the venture that you talked about, there's traditional equity, there's preferred equity, and there's also some of the project financing. And to really walk through and think about what's the right tool you have for what you're trying to accomplish. And I think that's another sign of the broader maturation of the alternative protein industry, that a lot of the different financial tools that have been available more broadly are now really becoming available for all proteins.
I have just one little thought, and I don't really recommend it, but I know some very early stage companies have done it, and it has helped them a lot. So sometimes you could also apply for grants, and I don't recommend it because it takes a lot of time and then they're highly competitive. But if you do have that extra time in different countries and ecosystems, there are different options available. So maybe just have a look, but if you can find another way, they're probably better, but just as an option, those are out there as well.
I'll just do a small plug. GFI has a competitive research grant program that is available for both academic researchers and startups. So for anyone out there interested in grant funding, check out GFI's website and to take a look there. And so, we were talking about different types of financing for different projects and what makes sense for each one. And we do have a question that is, I guess, asking a little bit more about that and really speaking to the value of using VC funds for brand development versus tech IP development. Should there be a balance between the two? Or how can you think about those two things?
I'm just when I wasn't yet in the investor and specifically in VC investment world, I remember I was being told that you only take venture capital money when you really have a rocket ship that you're trying to find rocket fuel for. So if you are building a lifestyle business or something that is like, can be self-sustainable or like something smaller, you don't go for the rocket fuel. You really go there if you want to go for the moon, Mars, wherever you're going, right? So ultimately, the purpose of the business is to grow and sell and be profitable and so on. So how do you get there with your IP, or do you get there with your brand being unique and selling to the final customer? I mean, I think it's ultimately important for the founders themselves to figure out what is their unique angle and how can they be differentiated for the final customers, whether it's tech or the brands. And I could say there are different type of investors out there, the ones who like to focus on a brand play and the ones who like more the tech. So you really have to know your VC investors well in terms of what plan you're going to put in front of them to make your company successful.
Absolutely.
Perhaps just adding, because it was mentioned before, the e-commerce delivery space that has probably been, despite what we think about is impactful or not, that has been the biggest category and that has been funded. And that's really about market penetration in a first place, which requires money, and where VC money in the food space has been extensively used for, so that you make sure you are in lots of territories, different SKUs, marketing spend, consumers are aware of what you're doing, and you might be loss-making for quite a while, but build that brand and use the VC money. So that's in the shelves, but that's also for your very competitive the food delivery segment.
So switching gears a little bit, we have a question here talking about the current investment climate seeming to impact early stage startups. Only about 20% of new startups will survive or make it through to a Series A. And they're wondering, do we still need new founders and new ideas, or do we need more collaborations, consolidations, pools of investment in this space to kind of get these companies to work together in a bigger way towards a shared goal?
I mean, I would be a hypocrite if I said differently, but my bread and butter is like early stage, new ideas, new companies. So I'm definitely excited about those. However, I do see that maybe further down the line, in a few years, we will see a bit more consolidation in the space. I think as much in the cell-based, but also on the plant-based side of things.
Yeah, I think it's interesting. I mean, it's still at a stage where you want to encourage more innovation, more ideas, more disruption, more creative approaches to problems. I mean, even just take cultivated meat. You know, there is so much great innovation, but also a need for continued innovation to think about how do you reduce costs and how do you think about effective ways of growth meeting and others. I will say that one characteristic about this industry means that it really is hard to scale because there is just such a high capital need to produce and make this food. Like if you think about what alternative protein companies need to do, there are three really big things which are hard for any company to do, much less a startup. They need to be amazing biotech and science companies to have cutting edge IP to produce and innovate what are these new proteins. They need to be great consumer companies to create a brand, to distribute, to get it out there. And these are things that Pepsi and Kraft and General Mills and others have done for years. And then they need to be a supply chain production company, which is occurring in some of the most difficult global supply chains that we've seen in a generation. And for any company to do all three, even for like the Fortune 100, is incredibly difficult. And if you think about trying to do all three as a startup with seed funding, it can either feel amazingly frustrating, but I would say it's an opportunity. Like every crisis, it's an opportunity to think about what are partnerships that you can think about, and really knowing what is your space and what you're going to do, and not trying to do everything. Because if the most important thing you're doing at an early stage company is managing your time and your resources well, how do you think about leveraging other things to not try to do all three of those at the same time? Because that's an incredibly hard thing. And again, I think they create some real opportunities for partnerships in our industry.
Yeah, and I would say we have another question that just came in asking what the biggest opportunities are to disrupt the market, and wondering if it's better to start a company from scratch, develop the latest cultivated meat company, or maybe build a company that provides technologies to other companies to really accelerate their time to market. And I'll say, particularly in the cultivated meat space, we are seeing so many more kind of backbone companies who are supplying things like cell culture media to the space to really accelerate that. Does anyone here on this call have any perspectives on that, of what they're most excited about, what they see are the big opportunities, Marylise?
Yeah, I just wanted to talk a bit about the cell-based industry. And 1.5 years ago, when we started Sustainable Food Ventures, we had the inner mandate that probably B2B companies in the cell-based industry are just a bit too early, meaning that if you embark on a VC investment for the next decade, it's probably too early for them to survive in the first few years, because just the sheer demand of the other companies is not there yet for their services. Now that almost 2 years has passed, the time for a scratch B2B cell-based company might already be there. I'm still a bit hesitant, but I think the time is coming closer and closer in terms of finding opportunities in that industry.
Perhaps something to add here, taking a very different angle, because we speak a lot about deep tech, biotech, reactors, food from vessels, etc. What we'd like to mention once in a while is that there is other opportunities for innovation that could even handle the humble soil and even make what we produce a bit more efficient. Crop variety is a topic, ancient crops, how you rotate, how you treat soils. There are big carbon sinks. There is a lot that can be done around soil health, soil quality, how we eat. There is a lot that can be done in terms of the machinery, how we work. Robotics is a big topic, automatization, because not everything that comes out of a bioreactor will capture the variety that people are used to eat. And someone today picks the strawberries, so that one is currently not available in that abundance where we sit. There is so many more opportunities for intelligent innovation to come in. Robotics to replace farm labor is such a big topic too. The soil topic that I mentioned, biologicals, pest management, pollinators, diversity. There's a lot of room for innovation, so you don't need to start a cell cultured biotech company from scratch to make a huge contribution to the agri-food tech ecosystem.
Absolutely. That's a great point, that alternative proteins are one piece of many in really transforming our food system to the better. We do have a question here that's a bit more granular, and they're wondering about cultivated milk and dairy products, which make real dairy from microbes. We haven't seen that many companies in that sector yet, but there are definitely a few, and it's growing. Is there any perception that this market has significant differences compared to the other markets for alternative meats, or do you think that it's pretty similar? Marylise, maybe you've done some thinking about this, given that so many of those companies are still early stage.
I mean, I feel like when it comes to milk as a category, there are like 2 different technologies in addition to plant-based that are being pursued. So one is the precision fermentation side, and then you have like the cell culture where you can actually like grow the mammary glands and then excrete like the milk in that way. I feel both sides are like, definitely there are more precision fermentation companies out there globally than in the cell-based side of things, but also those companies focus on different aspects of milk. So some of them just go for specific proteins, and some of them go even for like what is it called, like baby nutrition, or like if you go for infant formula, or like that area of things, and then you can go for like human or adult milk. So I feel like that the technologies are different, but also the focuses are different. And I still see that there's definitely room to innovate there. but I don't know if there's like a white space where no one has tapped in. I think there's something in every like square of things when you map it out, but still much less than in the meat space or seafood space.
Great. So we are running up on time. We'll do one more audience question and then one round robin question for all of our panelists to close us out. So the audience question is around the regulatory issues and how soon should a company begin to develop the regulatory strategy, start engaging with regulatory councils, and how important is that regulatory landscape and that regulatory decision-making in your decision to invest in a company?
I can go. I think that what got me excited about a week ago was the fact that it looks like UK might be starting to make some strides towards actually regulating the cultivated space in their country. So I think that is exciting what is happening. But for example, just today we were talking to a precision fermentation company, and we were telling them that if they look at relocating from where they are at the moment, we would recommend them to operate in a place where they can actually sell their products. So either in Asia or the US, but in Europe, it's going to take them, we don't know how long of a time to be able to sell their products. So I think it does matter in which type of environment you operate in. And if it's a difficult one, that you have enough of a runway to operate there, or a very specific way of how can you get through the regulations in that specific environment. Or if you're open to selling your product elsewhere or relocating, that's also an option. But I think this needs to be thought through before fundraising, that there is a bit of a plan in place in terms of how you're going to operate and make it happen what you want to do in the world.
And one of the differences that you asked about earlier, which we haven't talked about, is indeed time to market. And next to topics like GMO and where is it allowed at all to sell, is the novel foods versus grass, because a lot of the novel ingredients in the US, the grass process simply is shorter compared to the novel foods process. So that is a fact. I think depending on where you are, what you do, there is a visibility of, will this be approved, yes or no? Because very often there have been similar cases, similar species. Is it fungi, bacteria? So there have now been cases that one can look at and learn from. But yes, both processes, they vary in length, and that needs to be taken into consideration.
Absolutely. And in our last remaining minute, looking to the future. So let's say we're looking 10 years out into the future. What are the biggest opportunities that you see? What are you most excited about? Matt, maybe we can start with you, then Marilise, and close with Christina.
It's a great question. I think the biggest opportunities that I'm most excited about is for alternative protein to continue to go mainstream, in the sense that if you look at where electric vehicles and batteries are now, everyone are realizing that this is something that we need to think about and be behind the leadership of Tesla, obviously government subsidies and other things. So what I'm excited about for 5 years more is much more widestream adoption amongst a broader group of consumers and investors, and those who feel like this is a sector that they absolutely need to play in, given just the returns as well as the important mission.
I can go next. So also echoing the fact around, sorry, I kind of forgot what Matt was saying, and I agreed with it in my mind, but I can't remember now what it was. So I'll just go, if I remember, I'll tell it again. But the thing that I was thinking about was actually emerging markets and how they're going to evolve in the next decade. So, for example, we've invested in Veggie Victory in Nigeria, and Nigeria today is a 200 million people market, but I think in not in a decade, but in 2 decades, it's going to be 400 million, which is bigger than the US market. So I'm just very, very curious how these newer markets, in terms of like their development, what will be they approving as their main source of protein, and how will they be on this alternative protein journey? Just very, very curious on that front.
So I think a lot about food as medicine these days, and speaking about emerging markets, that's in places where you have the highest obesity rates. You can have obese and undernourished and malnourished people all in one township, but you don't need to go to South Africa. You can also look into the US, you can look into selected European, even Asian markets. So what we eat matters beyond the protein content. We talked about efficacy, bioavailability, fibers, nutritional content, and the belief that a lot of diseases can be prevented and to some extent treated by what you eat. And the gut microbiome health is a topic that's been discussed quite a bit. It's still a bit fussy scientifically. How can you capture it? Because it's a moving target, but that's certainly a space to be excited about.
Absolutely. Well, thank you so much to all of our panelists today. That's all we have time for. We're actually 2 minutes over time. So thank you everyone for joining. Remember, we'll be sharing a recording of this via email. We'll be posting it to GFI's YouTube channel. And please join us over at Meetaway to continue the conversation with other folks in the industry. Thanks again, everyone.
Thanks, Audrey. This is great.